Warren Buffett, the CEO of Berkshire Hathaway, is inarguably the world's greatest stock investor. Besides being an investor, he's a bit of a philosopher too. Buffett simplifies his investment ideas into easy-to-remember phrases. In this video, I share 8 rules of investing according to Buffett. Rule number 1. Never lose money. This might seem obvious, because no investor deliberately aims to lose their hard-earned money. However, unforeseen events can lead investors to overlook this principle. Buffett strongly emphasizes this as his guiding rule. Rule number 2. Never forget rule number 1. Buffett experienced a personal loss of around $25 billion during the 2008 financial crisis, and his company Berkshire Hathaway also lost its highly regarded AAA rating. Given these setbacks, how can he advocate for never losing money? Buffett is pointing to the mindset of a prudent investor. Avoid being careless, steer clear of gambling, and don't approach investments with a nonchalant attitude that considers losses acceptable. Instead, he emphasizes the importance of being well-informed, conducting thorough research, and approaching investments with diligence. Warren Buffett invests only in companies that he thoroughly researches and understands. He approaches investments with the mindset of not expecting to incur losses, and he encourages others to do the same. According to Buffett, the key attribute for an investor is temperament, not necessarily intellect. A successful investor doesn't follow the crowd blindly, whether going with or against it. While the stock market may encounter fluctuations, Buffett remains steadfast in pursuing his goals during both favorable and challenging times. He advises serious investors to adopt a similar unwavering focus. Rule number 3. Pick businesses, not stocks. If a business does good, its stock should go up over time. Buffett looks for businesses with promising long-term possibilities when picking investments. He checks if the company has a steady history, a strong business, and if it's making good and lasting profits. If the company's stock is priced lower than expected for its future growth, Buffett might want to own it. One of Buffett's success rules is that he won't buy stock in a company unless he can write down why he's okay with paying a specific price for each share. Other investors might find this exercise useful too. Rule number 4. A wonderful company at a fair price is better than a fair company at a wonderful price. Buffett is a value investor who likes to buy quality stocks at reasonable if not exceptionally low prices. His objective is to construct a stock portfolio that will yield substantial profits and capital appreciation over the long term. During the 2008 financial crisis, when markets were in turmoil, Buffett capitalized on the situation by investing billions in reputable assets such as General Electric and Goldman Sachs. Disciplined investors set specific criteria and adhere to them for effective stock selection. You might look for companies offering high-quality products or services with solid earnings and the potential for future profits. Establishing criteria like a minimum market capitalization, a maximum price-to-earnings ratio, or a specific debt level can guide your choices. The ultimate goal is to find the right company at the right price, ensuring a margin of safety against unknown market risks. Remember that the price you pay for a stock isn't the same as the value you get in return. Successful investors know the difference. Rule number 5. Favorite holding period is forever. Warren Buffett is a staunch advocate of a buy-and-hold strategy. According to him, you should only invest in a stock if you're comfortable holding on to it for at least 10 years. Otherwise, don't own it for even 10 minutes. During the financial crisis, Buffett retained the majority of his portfolio. Committing to a lengthy holding period prevents investors from making impulsive decisions unless there's a significant and negative change in a company's prospects like insurmountable labor issues or product obsolescence. Acting out of excessive fear or greed can lead to selling stocks at their lowest point or buying at their highest, ultimately eroding portfolio value over the long term. Rule number 6. Be willing to be different. Don't follow the pack, even if the leader of the pack appears to be highly successful at first glance. It's important to be cautious about relying on the opinions of the masses because their origins and basis may be unclear or even unfounded. According to Buffett, trusting your own instincts is crucial. Don't hesitate to go against popular sentiment. He started out with a $100,000 in 1955. It wasn't his own money. It was gathered from a handful of investors who trusted him even though he didn't operate on Wall Street. He chose not to disclose his plans or tactics to them, breaking a golden rule in the process, which was not informing his investors about where he was putting their money. He preferred to operate without their approval, trusting his instincts without interference. Ultimately, he turned that initial $100,000 into more than $100 million. Rule number 7. Avoid credit card debt. You can do far better things with your money than give it to credit card lenders in the form of interest in exchange for purchasing power you might not have had otherwise. The essence of investing is to earn interest, not to give it away. This forms the basis of one of Buffett's life principles, which extends beyond just investing. Buffett told an audience at the University of Notre Dame, "I've seen more people fail because of alcohol and leverage." He emphasized the dangers of being enamored with the amount of money one can borrow without adequate consideration of the ability to repay. The liquor reference might not need an explanation. It's clear that its influence might not always lead to the best decision-making. Rule number 8. Invest in what you understand. Buffett emphasized to the media during a press conference that investors should focus on what they understand. Restricting oneself to businesses within their comprehension is crucial. When you invest in an industry without a clear understanding of how and why it might succeed or fail, it's akin to taking a shot in the dark. Buffett's advice is grounded in his own experiences. He gained renown for avoiding investments in high-tech stocks during their early rise because he openly admitted to not fully grasping their nature and objectives. The message is clear. Refrain from placing your money in areas where you lack competence, at least until you've acquired the necessary knowledge. Take some time to educate yourself first. So, what is the essence of Buffett's investing principles? The short answer is to buy undervalued stocks with solid long-term potential. The longer answer is that it requires research and a steady commitment to the companies in which you're invested. Endure market fluctuations and hold on to your investments through various challenges, unless there's a significant change in the company's outlook, such as product obsolescence. In addition to looking at how well a company will do in the future and checking if the top leaders are good and if the company is financially stable, Buffett also cares about the size of the company in the stock market. He avoids very small companies and he checks if the company has a reasonable amount of debt and makes a good profit for each share of its stock. His aim is to identify sturdy companies with strong balance sheets and optimistic long-term prospects, investments suitable for long-term holding. Regarding the optimal duration to hold an investment, Buffett suggests that the ideal holding period is forever, and this isn't far from reality. He intends to retain his portfolio and might even increase his holdings if specific assets become attractively priced, even in times of significant market turbulence. As a long-term value investor, Buffett views volatility as a chance to make purchases at favorable levels or to capitalize on profits by selling some of his holdings if their prices surpass what he deems reasonable. Warren Buffett is undoubtedly an exceptional investor. He has achieved this distinction by adhering to some fundamental principles. I believe that by embracing his wisdom, you can accomplish much more.